So glad to be back in Minnesota. Just spent the last 2 months in Brisbane, Australia, which we'll be hearing about a little bit in this presentation. I had a wonderful time there. And actually, we'll be moving down there. My family and I are planning on moving back to Australia. So next month's presentation will be a continuation of what's become an unintentional blog that's detailed the process that we've been through in the past 4 years as we've moved our lives from the US to Australia and then back again, and now we're going to move permanently. All right, I have 7:30. I'm going to kick things off. Welcome to this evening's presentation. I'm Ashley Murphy, the founder and principal of Arete Wealth Strategists Australia. Thank you for joining me here for Aussie Dreams or Distant Nightmares, the reality of overseas property investment. Let's get into the presentation. Of course, please note that unless you are a client of mine, then I am not providing personal advice to you. And of course, only clients with whom we're having a private conversation are we actually providing personal advice to. So this does not constitute personal financial, tax, or investment advice. You're advised, this is the advice I have for you, is seek out your own private counsel that is appropriate to your circumstances. Please note, we have a YouTube channel where all of our presentations are based. There's several dozen there. I think there's about 50 there by now, including last month's presentation, Avoiding the Super Tax Trap, US Tax Rules for Aussie Retirement Accounts. That was one of our most well-attended webinars ever. So be sure to check that out. And if these are topics of interest to you, then be sure to subscribe to our YouTube channel, where you'll also be notified of new content as it becomes available. A little bit about me and my firm, Arete Wealth Strategists. So really, I was born into this cross-border world as a tri-citizen of the UK, Australia, and the US. Grew up in Australia. In early 2005, I set out on a world trip that ended in San Francisco, worked in corporate finance for a couple of years, and I started inquiring as to whether there was some sort of group or financial advisory group or a financial advisory firm that focused on the needs of Australians in America and Americans in Australia. As I was, given the complexities that I faced, I figured surely there's got to be others out there that need the kind of help that I know that I do. Sadly, I was disappointed, and it wasn't for another decade before I really went deep myself as a certified financial planner in discovering more about the intricacies of the US and Australia and the complexities of how they interact. And that's something I've been doing now for a decade. And I've been a financial advisor, as I mentioned, since 2010. Regularly speak at conferences and indeed host our own conference. So I'll be speaking at the XY Planning Network Conference coming up in October, and then again at the Global Financial Planning Institute in November. All right, kinds of examples that we help clients with include the three that you see here on the screen. So the Aussie business owner living between Australia and the US, the high net worth Australian family currently living in the US and really trying to live that globally mobile lifestyle, and then the Australian executive who's permanently relocated to the US. In fact, I just got an email from that particular client shortly before the webinar commenced tonight. So what sort of things did we help them with? They had the goals, I'm thinking here of the top client, of selling a business in the US, repatriating to Australia. That engagement went very well, able to achieve outstanding tax outcomes for that particular client. Next example here, moving a family from the US prior to being exposed to the Heart Act. Actually, they moved to Australia a few years ago, and that move, which was unknown to their immigration counsel, to their tax advisors, saved them millions and millions of dollars. Now, that's not to say that everyone gets hit with millions and millions of dollars in exit fees. One has to have a net worth where there is that to be saved in the first place. And lastly here, the Australian executive and family permanently relocating to the US. This is a client where I think it really demonstrates the significant expertise that we have in dealing with US financial matters. So we've set up a retirement income plan, repatriated almost all of their assets from Australia to the US, and set up a retirement income plan to provide all the money that they need to live their best financial life in retirement. So today's presentation, we're talking about Australian real estate versus alternative investments, meaning what else you might invest in, not necessarily far out there obscure investments. Update on the Australian property market, factors to consider when buying foreign real estate, what to do with your property if you're moving overseas, disadvantages to selling Australian real estate as a non-Australian resident, of which there are two critical ones. Have you considered all the costs of renting your property? Most people haven't. And lastly, for whom might it make sense to invest in Australian real estate? But I did just want to be clear, today is not a comprehensive update on the Australian real estate market. There are some other presenters out there that do a great job of that. One that I watch happens to be Dr. Andrew Unterweger. He came out with his update just over a week ago. I think it's a great resource, so feel free to check that out. So given what we do, given the perspective that we have in helping the clients that we work with, we're commonly involved in providing advice on decisions of when to buy, whether that be now or just moving back, or maybe the client wants to rent for a while, figure out the lay of the land in whatever city they're in, and then buy. We're also looking at the purchase options, so figuring how much can they afford to buy, how much is optimal for them in their circumstance to buy. Should they pay all cash? Should it be a mortgage? Should there be a redraw facility, or some other offset account in place? We're also looking at repatriating funds to Australia, so there's a significant foreign exchange impact, and then of course referring a lender. But importantly here, we do not get paid 1 penny when folks invest in Australian real estate. And that's why I'm excited to give this message tonight, because I am one of a very, very few voices that is somewhat against investing in Australian real estate when you are not an Australian tax resident. And I hope to make my case pretty clear. So you're talking with someone who does this, provides this advice all the time, and doesn't have an incentive to make the recommendation to invest. Where does someone with my particular set of interests come down on this particular matter? And we're about to see in just a moment. So the kinds of folks that we see that are typically looking to purchase or keep their real estate in Australia while in the US are most commonly your high-earning, time-poor expats who are leaving Australia for some sort of expat assignment, or maybe they're the same time-poor, high-earning Aussie expat looking to move back to Australia at some point. I would exempt the group that are just about to move, because in that case, many of the disadvantages that I highlight don't really apply. I'd say that's actually a circumstance where it does make sense to purchase. But if your domicile uncertain, you don't really know when you're going to move back, you do know that you will move back, and maybe you've listened to one of these online spruikers or promoters that have said, hey, buying Australian real estate is a great idea. I'm here to say probably not. Okay, so what are some of the other alternative options that you might have for your investment dollars if you're leaving Australia or considering what to do with your hard-earned money from overseas? I would say consider investment real estate perhaps in the US, in the time that you're in the US at least. Fixed income or cash, remembering that we're earning about 5% in cash accounts right now in the US, in high-yield savings accounts, or the stock market. As you're about to see in a coming slide, the long-term returns of the US stock market absolutely smother what we see with Australian real estate. There's really no comparison. I hope to make the case that it's mostly only going to make long-term financial sense for one of 3 groups to hold Australian real estate when you're a non-resident. Now, note my emphasis on when you are a non-resident. This isn't a blanket message to say don't ever hold Australian real estate. It's just when you're a non-resident, and I hope to make my case clear throughout the presentation. So what are those 3 instances? 1, if you're moving away from your main residence for a short period of time, define a short period of time. I would say less than 3 years. That's the number that I come up with there. Less than 3 years. Is that written in stone somewhere on a mountain that says thou shalt not own their Australian real estate if they move away from all the 3 years? No, it's just a rule of thumb. The emphasis there is on a short period. Why? We're coming to it later, but essentially, if you come to sell your house, you do not get a capital gains tax deduction on the time that you are a non-resident. The way that the capital gains treatment is applied is you would bifurcate your periods of ownership to when you're a resident versus a non-resident, and that gain that occurred in that period of non-residency is taxable. So that's not good. Second point would be you're soon to move into your residence from overseas. Okay, fair enough. That's kind of self-explanatory. Or 3, you plan to use your property for more than 2 months a year. Now that is an interesting one, and I see the client for whom I was making this recommendation to about a year ago, right here on tonight's call. So that's kind of funny to see that. But we did the numbers. We ran the numbers. Here was a client interested in splitting his time between Australia and the US. And he said, well, what would it look like if I rented an Airbnb for 2 months a year versus just buying this property in Melbourne? And we ran the numbers, and it looked to be at about the 2-month mark where it became cash flow neutral to own that property. And that's a critical point, because if it's merely cash flow neutral, that means that any upside capital appreciation in that property is really just a free return that the client has. So I was happy to recommend that and add that as a scenario where I think it does make sense. Oh dear, what's happened? Sorry, one second. What's going on here? Oh, I think I know what's happened. Okay, so let's look here at the combined capitals, house and unit value for the past 30 years. This is a core logic that you're seeing here. This is taken from a paper of theirs, The Long Game, 30 Years of Housing Values. It came out about 2 years ago. And what it's showing you is the extraordinary growth in Australian housing value in capital cities from July 1992 all the way up to July 2022. So you see what's happened in that time, that the property has increased in total by $760,879, or 453.1%. An incredible return, no doubt about that. And then we can see the chained periods at the bottom of this graph. So for the first 10 years, houses made 89.4%. In blue, we have units. Units were up 80% over that period. The next 10 years, 60.5%, very strong return from 2002 to 2012, although still coming out of the backside of the global financial crisis at that point. And then the last 10-year period from July 2012 to July 2022, up 82%. Pretty good, right? I'm happy with that. Well, let's see something over here. What if we were looking at the S&P? Sorry, this. What if we're looking at the S&P 500 over a similar period of time? And that's actually what I've graphed out here. It's not showing up perfectly. I apologize, but I did do the exact calculations prior to the presentation. So you can see here, here's the S&P over the same 30-year period. So what sort of returns did we see from that? Well, the S&P began in July 1st of 1992 at 412, ended 10 years later at 1,002. It was up 143%. So we're seeing a 53% difference to what we saw with Australian real estate for that period. We're seeing a 38% difference. Excuse me, sorry, I'm reading the 143% growth over that period, which was 53% more than Australian real estate. 38% growth, which was the only period that was actually less than Australian performance. So from 2002, remember the US was still in a bit of a recession following the 90s dot-com boom and also September 11th. So we were coming out of that period and then still coming out of the global financial crisis. So up 38% for that period, but then up a whopping 186% over that last period, up from July of 2012 to June 30th of 2022. so outpacing the Australian market by 104%. So we saw in total an 861% return for this period for the S&P 500, which outpaced Australian real estate by 408%. 408%. I am called to think of an incident that happened 2 years ago when I did a webinar, and a guest mistakenly said that, in fact, the real estate outperforms fixed income. And it was because of that. I thought, I've got to spend the time, I've got to show the numbers and really make it clear that anyone can go and look at these publicly sourced numbers from the most reliable of sources, I might add, and see exactly what I'm saying here. So vast difference in return over that 30-year period. Okay, there's been a chat that's come in. I love to engage with the chats here. Sean asks, can you comment on how the S&P 500 returns compare to an Australian equivalent? Sean, I was afraid someone would ask that. And I think so I did not look at that specifically, but I don't think it would have been as much. So if that was the general point that you were making there, I would be inclined to agree. I would say they're probably similar. I would think the ASX 50 would still outpace real estate returns by a much smaller amount, but that's what I would expect. Anyway, I did not do the analysis on that one, so I can't say that for sure. Okay, so Australian real estate. Let's look at some pros and cons here. I am not in the business of selling people out of Australian real estate like as if it's a terrible investment for everyone. It is definitely not that. Let's look at some of the pros. So there's growth driven by strong population growth. We saw the high watermark in that a year ago. It seems to continue despite political pressure for that to stop, but apparently the politicians are not paying any mind to that. There's a lack of inventory, which is, of course, when you think of supply and demand, if the demand side stays constant and supply is limited, then that's only going to drive up prices. There's massive infrastructure investment driving further development. For those that may not be aware, Australia is a real innovator in the world of public-private partnerships and funding major infrastructure projects. Indeed, that's how an investment bank like Macquarie came to be of the size and magnitude that it is. Negative gearing potential. This is something that the Australians got rid of the Americans got rid of back in the 80s. We no longer allowed passive activity losses for residential real estate investments. Only similar passive activities can be deducted, but not in Australia. If you've got loss-making investment real estate, you can just deduct that off your income. I struggle to find the investment thesis where losing money somehow makes you money, other than consolidating your improvements into a particular year that corresponds with high income. And then the improvements that you made would not only add to your rental price, but to your ultimate sale price. There's one scenario where that seems to work. But other than that, I think this is heavily sold by, again, property spruikers and accountants. Next, provides stable inflation-adjusted income. That's certainly true, although we do run up against limits on affordability, as we're going to see in a future slide. The beauty of real estate is it can be a use asset, something you can use, and an investment asset. So you don't need to use it, you can hold it, you can have tenants, and it can improve in value. It's also less volatile, or it's thought to be less volatile than stocks and equities, which I happen to think is really just a function of its lack of liquidity and it being less frequently priced, unlike the stock market where it's priced every millisecond that the markets are open. But in any case, so what are some of the cons? Well, as a non-resident, keep in mind you do not have access to the capital gains discount. So that's to say that the 32.5% rate that starts at the first dollar of gain or income applies to you, and you're in that 45% bracket at 190,000 Australian dollars. So any gains are getting taxed at those rates. You don't get half off like you do if you're an Australian resident. There's also no main residence exemption. This went away back in 2020. And so if you got that great promotion, you don't know what to do with the house, so you say, oh, we'll figure it out later, and then you just move overseas, and then for some reason you say, you know what, this is really just a money loser for us because we're still paying on the mortgage and the tenants aren't paying enough rent and they're a hassle anyway and have to file tax returns, all the laundry list of other headaches that go with it. If you sell it, you do not get your main residence exemption, and so you're paying capital gains tax at the non-residence rate, refer to the first con that I've got here, because you didn't sell it while you were an Australian tax resident. So that is very bad news. For non-Australian citizens of permanent residence, there is actually, and this presentation is not geared to such folks. So if that's who you are, if you are an American or from some other country and you don't have Australian citizenship or permanent residence, there's a whole host of other things that are out there. There's punitive stamp duty rates, there's absentee taxes, there's withholding with the Foreign Investment Review Board, and so on and so on. Real estate in general suffers from high transaction costs. They're much lower. At least real estate commissions are much lower in the US. They're getting more competitive in the US with the passing of a recent court case that means that real estate commissions are going to be coming down a little bit. But still, as of 2024, the first half of 2024, the highest in the world, on average at 6.4% in the US. In Australia, it's actually less than half of that, and most people don't have an agent when they're buying. It's just the selling agent that gets paid. But in any case, there is stamp duty. So the total transaction costs in Australia do, funnily enough, end up being about the same as what the US is. It's just instead of paying a realtor for doing a job that they do for less than half the price in Australia, you get to pay stamp duty. Now, stamp duty isn't all that bad because it's essentially your annual, it's equivalent-ish to your property taxes that you pay in the US. It's just paid as a lump sum at first. It varies depending on the state, but typically you're looking at between 5 and 7% of the purchase price is going to go towards stamp duty, and it's double that if you're a non-Australian, non-permanent resident. Okay, it's highly illiquid. You can't get your money out very quickly. If you had an offset account, all right, you can get your money out pretty quickly in that case. But if you didn't have an offset account, you're having to set up some sort of home equity line of credit or hope to sell the place if you want to get all of your money back. Ongoing management and maintenance, that's especially necessary from overseas if you're going to be managing your property and the toilet breaks, or you need to find a new tenant, then having professional management in place is going to be very valuable. In Australia, we're seeing low housing affordability, which perhaps, won't say for sure, but perhaps that's putting a cap on the rental price growth that we're seeing, which has really slowed down dramatically. It's actually the slowest it's been now in 5 years, in the most current quarter, according to CoreLogic. And also a lack of depreciation allowances for all but new construction. So that's something that does differ between Australia and the US right there. Sean asks again, can you comment on roughly what the capital gains rates in Australia are or how they compare with US rates? You know, Sean, what a great question, because I actually can do that very easily. And that's simply by going over here to my key financial data sheet, clicking on the second page. You can also access this, I might add. I'll just zoom in on this because it's probably microscopic to folks out there. But you see here, in the 2024-25 Australian financial year, we're seeing 30%, excuse me, I said 32.5%, 30% for non-residents from the first dollar, and then 45% from $190,000. Capital gains tax, essentially the way it works in Australia is if you're an Australian tax resident, it's half of the marginal rate. So that would be 8.15, 16.5, or 22.5, depending on the situation here. So technically, the way that the CPA will describe it to you would be to say, if you bought a house for $500,000, investment property, $500,000, sold it for $1 million, you've got a $500,000 capital gain. That $500,000 capital gain is then given the way it works is half of that gain is excluded. So that's 250 is then charged at your marginal rate, which is mathematically equivalent to saying, let's just use half of the rate because it comes out it comes out the same. Okay, so that should answer Sean's question. John Deck has his hand raised. John, I would encourage you to write in, please, using the chat feature, whatever your question happens to be. Thank you very much. Okay, so coming back here, just loading right there. Next, let's look at the home value index. Where are prices in Australia right now? Well, I was shocked and appalled to see that Brisbane has overtaken Canberra to now be the second most expensive Australian city. Melbourne's actually been going in reverse over the course of the past year or so. Sydney is well ahead, really being a significant international city that it is. And then over here on the right-hand side, you can see the combined capitals. Median is 884. The regional is quite a bit less, but not that much less, not way less as you might expect. So 630,000 is the median regional price, and then the national median is 798. So what has happened over the past year to July 31st, 2024? This is what we've seen. Excuse me, look at that. Melbourne's actually up slightly, but it was the period, the quarter immediately before that where it was negative. It's been Hobart that's been negative. We've seen Sydney move ahead, but at a much more tempered growth rate. Brisbane really growing rapidly. Same with Perth, a shocking growth over there in Perth. Same with Adelaide. Darwin, things are still moving along as with Canberra, and then we see the combined numbers over there. So still very strong growth, but the thought is that this is beginning to slow. So what sort of growth have we seen since pre-COVID? So the onset of COVID, again, sourced from CoreLogic, really formerly known as RP Data in Australia, really the best provider for real estate data in Australia. What are we seeing? We're seeing prices are up 28.7%, $262,000 from the onset of COVID, and they're currently at their peak. So they're at their highest values ever in Sydney, Brisbane, Adelaide, and Perth. From Hobart, it's actually down, which is a surprise. And Melbourne, coincidentally, also down. Darwin and Canberra down as well from the peak, I should say, to July 2024, not from pre-COVID to July 2024. So we need only look at the peak. So Melbourne's down 4.4% from March 2022, and Hobart's down 12.5% from March 2022 as well, etc. So significant increases across all capital cities from the onset of COVID, with affordability becoming a major sticking point to future price growth. It's now seems like it's a two-speed market with wealthier clients who are able to continue to buy with cash or take on investment mortgages. We've seen a spike in the number of mortgages that are for investment purposes, which is interesting. But the growth rates of houses is slowing, whereas the prices for units are increasing, likely driven by that affordability dynamic, given that houses are more expensive than what units are. People are piling into units and paying more for them. Well, let's talk about yields, rental yields. What is yield? Let's define that term. Yield refers to what you're earning on your property after you pay the gross yields is essentially what the rent is on the property. That's what you're getting. So the combined capital here is 3.5%. That's to say, if you had $1 million property, you just paid your $1 million, you then paid another $60,000 in stamp duty, you own your $1 million property, you're able to rent that for a little less than $3,000 a month. So you're getting $35,000 a year. Just as we think about that, just as those words hit your ears and you start to process that, when you begin to think about all the expenses that it takes to actually own a property, such as the property management, the insurance, the repairs that need to be done. I haven't even mentioned mortgage interest if you're buying a property with mortgage. You can see very quickly what the broader point of what I'm saying here, and that is with rental yields like this, you ain't making money on a cash flow basis. You may possibly sell that property for a higher value at some point in the future, But don't forget what it costs you to carry the property and subsidize your tenants in the meantime, because that's effectively what you're doing. So we have a quote here from CoreLogic from that report: with value growth meaning the price of the house overall, outpacing rental growth, we could once again see some downwards pressure on gross rental yield. So that's to say there may be pressure on that yield coming down, because ultimately a house is going to rent for what the market says is fair, but that's going to be dictated by what people are able to actually pay. Gross rent yields have been fairly steady, hovering around 3.5% for the last 2 years, and rent yields are expected to compress slightly in the next few months as the pace of capital gains has held slightly higher than the slowing monthly rental growth rate. So this is also a negative indicator. Next, global debt service ratio. So let's look at how Australia compares globally when we think of debt service ratios. The vulnerability, and this quote is from this economist Diana Musina from AMP. She says the vulnerability of the consumer to rising interest rates was always our biggest concern in a country like Australia, where households are more vulnerable to rising interest rates. Why? Because in Australia, it's almost a mirror opposite of the US, and that is everyone is on a variable rate mortgage. In the US, it's the total opposite. Everyone's on a fixed rate mortgage. And so when rates go up, people feel it very quickly. So there is clear in Australia's high debt service ratio, percentage of income that goes to servicing debt, which is one of the highest in the world. So that is not good. This also suggests an upper limit to the amount of interest rate increases that may come through. If there were to be another one, I would have to think that would be it, given how much pain is being felt broadly in the market, and what we're seeing here as this chart clearly shows. So let's switch gears and talk about lending considerations. You're thinking of buying a property in Australia, you'd like to get a mortgage. What are some things that are a little bit different about this situation compared to obtaining a mortgage just as a resident? Well, there are a few things that are different. So you may face higher interest rates compared to resident borrowers. There's additional fees to compensate lenders for the perceived higher risk of you being overseas. Only a portion of your foreign income might be considered by some lenders. The reason they do that, by the way, I always wondered, that seems weird. Why do they do that? And it turns out that's their way of hedging for currency volatility. So they'll say, we're only going to consider 80% of your income. So that's something to be aware of. And also currency fluctuations. I have been absolutely shocked and horrified. That's just for my own personal reasons that I say that, the horrified part, about the rapid increase that we've seen in the US dollar to the Australian dollar in the last 2 weeks, from, I believe it was August 5th, that there was the flash crash. The Nikkei dropped by the most it has since 1987. The Aussie dollar dropped intraday down to 63 cents. We're now approaching, we're in the 67s at the moment. So we're talking 2 weeks and 4 cents. That is incredible. That's one thing to note for me, but if you were paying a mortgage on Australian dollars and you were reliant on sending US dollars to Australia to pay that, then suddenly your mortgage bill just increased in the space of 2 weeks due to this currency volatility. Now, that sort of volatility isn't so significant. It's more the longer term. If you had a 30-year mortgage and rates changed as much as they have just in the past dozen years, where we saw an intraday higher of $1.11 back in 2011, and as low as 48 cents in the early 2000s, the knock-on effect could be significant. That's the point there about currency fluctuations. And the big four banks generally require borrowers to be permanent residents or citizens, with some exceptions. So that can get tricky with clients who are moving back, who may be in a mixed nationality relationship. You really only want the Aussie on that mortgage application, or can only get the Aussie on that mortgage application in the first place. That can be problematic if the American happens to be the breadwinner. Okay. Factors to consider when buying foreign real estate. And we add some additional factors here if it's an American buying this foreign real estate. So First thing is conducting due diligence from abroad. That is tricky. I think we're better served at any time in history, right? With realestate.com.au and with Zoom and with all the incredible resources that are available online, but they're no substitute for actually visiting a property in person. Next, foreign tax filings. Don't forget, if you own investment real estate that's producing Australian taxable income, the ATO is going to have their hand out to take their fair share of tax out of that. And at what rate are they going to take it out at? 30% from the first dollar, as we learned before. Why? Because you're an Australian non-tax resident. So there's the foreign exchange fluctuations you heard me just mention on mortgage servicing, and much worse, and I should have mentioned this a minute ago, but much, much, much worse is a scenario that can come up from time to time, depending on where we are in the foreign exchange markets and this relative strength, and also where we are in the Australian property market. And that is to do with ghost gains, taxable US dollar gains on the sale of Australian investment real estate. How does this happen? Well, let's say you buy a property for $1 million and then Australian dollars, and then you sell it later for $1 million. So there's no change on the Australian side. But when the property price is translated back into US dollars, if at the time that you purchased the property, the dollar was weaker, and then at the time you sold the property, the currency change, even though you haven't pocketed $1 of gain in Australian dollars, the currency change that occurred on the US dollar side can lead to ordinary income taxation on that foreign exchange that you realized. So bad news yet again. Locating a borrower and obtaining a mortgage from overseas, that's not easy. Even the folks that I've referred clients to, they've expressed concern about how difficult just completing that process is from abroad. It's not as easy as doing that in Australia. Property management, of course, locating a property manager is difficult enough, but then having someone you know, like, and trust to manage that property and do so at a fair price can be a challenge. Estate planning is another thing. What are you going to do with your Australian property if you're located in the US? Well, really, you're going to want to have that either in a trust, which could bring up other US tax issues. So you want to seek counsel about how to do that. Or secondly, you want your own Australian will to govern that property, because your US will, although technically a signatory to the Washington Convention that allows for international wills, probate has to pass in serial, meaning it needs to be granted first in the US and then granted again in Australia before that property could be distributed. That could take years. That would be a real disaster, very slow, public, and expensive. So nobody wants that. And then lastly, changes in law. Oh my goodness, how frequently do laws change to do this? There's been this proposal about a change of residency definition in Australia, which has not happened, I might add. There's changes to superannuation that happen every single year. Coming up in a few slides, you'll see the change that occurred to the Main Residence Exemption, capital gains exemption. These are things that are changing all the time. So that's what you'd have to consider buying foreign real estate at any point in time. It gets even more interesting for the American looking at buying foreign real estate. Why? Because there's the savings clause that says if you're an American tax resident, you're always a tax resident. That's what the savings clause means. It means it saves the US from losing out on exemptions that may have been possible with the tax treaty for American citizens. So that rental income is US assessable income, which I should make mention of. Sometimes people on Reddit forums or Facebook, I like to say the value of the advice is worth what you're paying for it in those situations. The Australian rental income, some people say, well, just make a concessional contribution to your superannuation account, and then you don't have Australian taxable income. True. Okay, you could do that. And that actually could have two flow-on effects. One, it's not tax-free income on the US side, so it's assessable on the US side and accessible possibly at the state level. Most states, California, New York, and Minnesota, it is assessable income, so you get to pay income tax at the state level as well on that Australian income. And secondly, by making that contribution to your superannuation account, you may tip the scales as far as the US's treatment of your superannuation account. I'd encourage you to see last month's webinar on avoiding the super tax trap, because that's where I get into detail. So you could accidentally flip your superannuation from being an employee grant or trust, which would only be taxed at distribution, which for the Aussie expat only planning on being in the US for a finite period of time, would be a tax disaster, because then for every year that they hold this super fund, they're having to pay tax on the gain in that super fund. So you don't want that. Another thing you don't want to have to deal with is Form 8938. This relates to FATCA. We've probably all heard about FATCA before. It's a statement of specified foreign assets. And that's when you have certain foreign assets, real estate in this case, above a certain limit, you then have to file another tax form. Filing an information form isn't the end of the world, because after all, there's no tax that's assessed on an information reporting form, but the penalty comes from not filing it, which starts at a minimum of $10,000. Sean, how does the risk of ghost gains on Australian real estate compare to that with securities? Are you exposed to the same risk in purchasing shares of Australian companies? You're actually not, and that's a great question, Sean. You're asking a lot of good questions tonight. And here's why, is because for what's called intangible property, such as owning stocks, the capital gains is sourced to your country of residence. So if you owned a portfolio of individual Australian stocks while you were in the US, let's say you bought them before you left Australia, well, you're on the hook. That's going to be Australian taxable property. So that's bad news. The ATO will want to collect their tax on that when you get back to Australia. But let's say you didn't do that. Let's say you purchased this portfolio of Australian stocks while you were abroad. Well, if you sold that after some period of time, then it's taxable back in the US. It's converted back in the US, and you don't run that particular risk. And that's because really the exchanges that you're working with are converting it back to US dollars in the first place. I'm thinking Interactive Brokers would really be the only broker I'm aware of where you could actually have a US registered account, own Australian individual stocks, and then it be properly reported with 1099s and all the rest of it. The question unfortunately does go down a bit of a rabbit hole, because it brings up the possibility of passive foreign investment companies, and that's no bueno. We don't want to do that because there's punitive taxes associated with that. There's a white paper on my website you can go and read about PFIX and why you don't want to get mixed up with that. And then the last point here is, in whose name should you hold title to the property and the mortgage on? Typically, I would say you want to hold title to the property in the Aussie's name. And if you need both people on the mortgage, then I would do that too. In fact, in most every instance, if you can get both parties on the mortgage, that's great, but only the Aussie on the property title. Why? Because in Australia, they have a main residence exemption that's unlimited. In the US, they don't. It's $250 for married filing separate, $500,000 for married filing joint. Pretty generous threshold, right? But consider some of the heady gains that we've seen throughout tonight's presentation, and you can see why. If you put the American on the title, suddenly you just invited a tax bill that you didn't have to incur had it only been the Aussie on the title in the first place. So let's just take a breather here, see if there's any questions that have come up with folks before I move on to talking about what you do if you are in that position where you're looking at moving overseas, and what you should do with your property at that point. I just lowered John Deck's hand there. No other chats coming in, so I'm going to continue there with where I was. So some questions to ask yourself about moving overseas and what to do with your property. How long will you be overseas for? You heard me say earlier, 3 years-ish would really be a threshold for me before I'd say, you know what, it's going to really, excuse me, not make great financial sense to own it for much longer than that while overseas. Opportunity cost of capital, that's a fancy way of saying, what else could you be doing with that money? You own this investment property in Australia. it's worth $1 million Australian dollars. That's 670,000 US dollars. What could you be earning on that instead? Well, at a minimum, we know that you could be earning 5% in a savings account that would take you all of about 10 minutes to open and put your money into. So opportunity cost of capital. I also, in a webinar 2 months ago, I spoke about the decision-making process you should go through when thinking about where to hold excess capital. And in that webinar, I did a much deeper dive into a comparison of expected returns between Australian stock markets and US stock markets. So Sean, you might do well to check out that webinar. What's your time worth? This is the thing is, I know as I've gotten older and deeper into my career, the value of my time has gone way up. And I tell you, completing additional tax returns or dealing with property managers or finding tenants or going to closing ceremonies or whatever the case is, it's all something I could be doing, something I'd much rather be doing instead, or possibly be making money at some other activity. Will your renter really help you pay off your mortgage, or are you subsidizing them? Now, that's a cheeky, provocative bullet point that I've got in there, but I'm trying to stir the pot intentionally. I'm trying to say, do an analysis, and I've got a list of all of those expenses you should be mindful of when you think about renting out your property, but do a property analysis to see whether your rent truly is covering all of your expenses. We saw it just a few slides back. The average gross yield is 3.5%. Probably not. Okay, and think twice. This is what I said a minute ago before making a I actually was speaking about concessional contributions to eliminate the Australian tax, but think twice about making a non-concessional superannuation contribution for you and your spouse if you're moving to the US. So you think, hey, we'll sell our house and then we'll put all that gain into super as a non-concessional contribution. We can make $360,000 as using the 3-year bring forward rule for each of us. That's $720 for the two of us, assuming each of us have below $500,000 in our superannuation accounts. What a great deal. Well, maybe not, because that could have that inadvertent effect of flipping the way that your superannuation account is treated. Steve, thank you for the question. Another issue we discovered last year was that once US taxable income is above 180,000, the Aussie property expenses are not allowed deductions. You know, Steve, I'm going to have to ask you more about that, because that's the first time I've heard that one. Another issue we discovered was once US taxable income is above 180,000, the Aussie property expenses are not allowed. I hadn't heard that one before, but that is certainly not adding to the case for why you should hold Australian real estate as a non-resident. Okay, here are the two that I mentioned earlier that have gone away that really, really make it very punitively taxing to own investment real estate from abroad. One is the main residence exemption went away. So if you sell your property before you move overseas, you do a lease back to the person who's going to move into it for a few months while you figure out everything. That house sale was capital gains tax free to you. What a beautiful thing. If, on the other hand, you sat on your hands for 6 months and said, oh, I don't know what I'm going to do with my house, and then sold it once you're a non-resident, the whole thing is taxable at non-resident rates. And what are non-resident rates? Start at 30, work their way up to 45%. You could have just created a multi-$100,000 tax bill for yourself that you did not need to create. The other one is the loss of which adds insult to injury, is the loss of the capital gains discount exemption a dozen years ago. So that means there is no halving of that gain. You pay the whole thing at the Australian marginal rate. So very, very unpleasant. How have you considered all of the costs of renting your property? I remember back in the day, I had a mentor when I was going through UC Berkeley Extension, Rich Arzaga. He's actually since retired, and he was a noted financial advisor who dealt in real estate. And I was excited to take his course because I was interested in real estate as well. And I found actually that the course really could have been condensed down to probably 2 lectures from the 12 that it was. And one of them is here, what I'm giving you right now, and that is you can create a spreadsheet. We have our own proprietary spreadsheets that we use with clients, but you can create a spreadsheet where you're calculating the total rental income that you expect to make from a property and sure to subtract every expense, including mortgage interest if you have a mortgage, staging for the rental listing. That's not free. The property manager is probably going to charge you for that property, or if they didn't, then it was worth it cost someone some time, even if it was your own time. Property management, they're not doing that for free. Body corporate, good one, thank you, Russell. Another one, body corporate, as they call them, HOA fees in the US. If it's a unit in a building, renters, repairs, and maintenance, that's difficult to predict. Certainly, the newer the building, the less you're going to likely have of that, unless it's a cheap build. Or an older building's gonna probably have more of these issues. Landlord's insurance, that protects the property from the walls out, so the structure of the property. That for some reason, just as I think about that, we never had a claim. So when my family was back in Australia for 2.5 years, we rented a wonderful house in Brisbane, and we were there during the time of the flood. It happened that the landlord owned our house and the property next door. Well, ours didn't, but the property next door flooded. Real bummer to be a landlord or a property owner, honestly, in that situation, but especially difficult if you're dealing with that sort of thing from overseas, where you can't rent the place out for a year or two while you get that remediation work done. Property taxes, not nearly as high as they are in the US, but they're not zero. Tax filing, remember, it's not just the cost of the tax filing, it's the cost of your time in doing the tax filing. And people often forget to include a vacancy allowance. And what's a vacancy allowance? That plays into that very first calculation of your rental income. If you assume that you're renting your property 52 weeks of the year every year, you're probably overestimating the amount of income you're going to get, especially if there's a week or two between tenants. That's obviously not going to be making you money. Sorry, let's go back there. And don't forget changes that happen to tenancy laws. Again, this is a corollary of this lack of affordability that we're seeing. It's becoming a political hot button issue. People cannot afford to buy homes. Therefore, what's happening? The politicians are paying more attention to the tenants. So now, as of just a few months, actually, was it even a few months ago? It might have been July. It was as recent as July. Rate increase frequency, you cannot do it more than 12 months. So if you had 2 tenants in each for 6 months and you said, I'm going to raise it from the first to the second, you can't do that anymore. It has to be 12 months rental increase rates. And also there's a cap. If you figured you wanted to, say, quote unquote, self-insure for a dodgy tenant by taking maybe a 2 months deposit, you can't do that. You can only take a 1 month's rent for fixed-term general tenancies. So the reason I mention these aren't the end of the world, these tenancy laws, but anyone that's had experience on the US side, they know that if you get a rental property in a place like San Francisco, it is a complete disaster. And that's kind of where I'm seeing the puck going with regards to where tenancy laws could ultimately get to. I'm not saying necessarily San Francisco, but anyone who's familiar there knows that you could have to pay tenants tens of thousands of dollars to terminate a lease in the event that you want to move into the property, or if you want to sell the property. That's where these tenancy laws can end up going. So for whom might it make sense to invest in Australian real estate? Let's think about this. It's got to make sense, right? And it does. You or your partner are Australian citizens or permanent residents. That, to me, that's absolutely essential, because all of the doubling of the stamp duties and the review by the Foreign Investment Review Board and ghost taxes and all this other nonsense, that applies if you're not an Australian citizen or resident. So that's a whole nother presentation. And to be honest, the addressable audience for my presentation, which are Australians in America and Americans in Australia, don't really have that issue so much, because if an American's moving to Australia, they're almost always doing it with their Australian partner, or they have some sort of visa or permanent residency situation already figured out. You plan on moving into the property in the near term, or will be using it periodically. That is, you'll be staying in the property for greater than or equal to 2 months per year and renting it while not there. That's not to say you just leave it vacant for the other 10 months of the year. It has to be rented for it to possibly be cash flow neutral. Third, you've conducted a property analysis to determine your holding costs so you know what you're looking at if you were to rent it and how much you're out of pocket in doing so. And fourth, you're likely to become an Australian tax resident at some point in the near future. Now, don't be confused there. As I'm talking about citizenship, which is a legal status, versus a tax status, which is Australian tax resident. Because remember, Australian citizens are also taxed at the non-resident rate when they're overseas too. There are some other advantages that Australian citizens have when buying Australian real estate from overseas, but the tax residency is not one of them. And so ideally, you don't want that period of time between purchase and resuming Australian tax residency to be too long. Why? Because that period of time that you're out of the country, you're paying non-resident tax rates on the income, and any gain gets apportioned to the period of time you're a non-resident and gets taxed yet again at non-resident rates. So very, very punitive. Next, you're planning to relinquish your US citizen or permanent residence. Now, I put that under optional only because being a US citizen and owning really just about anything abroad brings up a host of complications. And so the idea here is you could go on the title with your spouse if you're giving up your citizenship. Of course, you'd want to listen to the webinar that I did on the Hart Act and the US exit tax to determine how that's calculated, because you could have an exit tax issue. You want to seek personal and professional advice if that's something you're thinking of doing. I'm not recommending it to folks. I'm just saying that's an optional consideration that would improve your net gain position in Australian real estate. So the summary of pros and cons then for Australian investment real estate as an American resident. What do we have here? We've got regular inflation indexed income, but probably not enough to cover your costs, so you're subsidizing your tenant. You've got capital gains potential. That's nice, but if you're not an Australian tax resident, you're paying at non-resident rates with no CGT exemption. And then worse, I didn't mention this earlier, at the state level, there may not be recognition of the tax treaty. So you may pay Australian non-resident rates and California or New York or wherever state tax rates. As an Australian tax resident, you may possibly employ negative gearing on investment property once you assume Australian tax residency. So emphasis on Australian tax residency there. So that's a good thing. At least it's a good thing for the individual. I won't go any further with that comment. It's paid in local currency, so that's nice, but you don't get long-term capital gains concessional treatment, nor do you get main residence exemption treatment. So the list of cons is quite a bit longer. Very low gross yields. That is, as I said, you're probably subsidizing your tenant. You get a range of penalty taxes as a non-resident owner. As a non-citizen owner or non-permanent resident owner. Australian sourced income, so you got to file Australian taxes. Property management costs and hassles, foreign exchange costs and hassles. It's illiquid. You can't get your money out easily or quickly. There's high trading costs. There's a part of me, yet again, I say this, to stir the pot and to get people animated, but what's it cost to sell an ETF or a stock at Schwab or E-Trade right now? It costs exactly nothing. What's it cost to buy a home in Australia? It costs you, well, about 6%. What's it cost to sell a home? It costs another 2.5% or so. So significantly high trading. So that's, in other words, that's $60,000 on your purchase and another $25,000 on your exit. And significantly lower performance versus the US stock market, as we saw with that S&P comparison. Mark has his raised. If you have a question, Mark, feel free to type that into the chat. That would be great. Otherwise, I should mention that if you want to learn more or feel like something I've mentioned here tonight is applicable to you and your circumstance, feel free to come to Arete-WA, that's my website. Click on the Get Started, and that will run you through the process that we have for onboarding prospective clients. Alternatively, you could go there and click on, going back a step, click here on the Knowledge Center, and you'll be able to download our latest key financial data sheet, as well as you'll find all of our webinars there. We've got various flowcharts, white papers, blog posts, a whole host of stuff. Next month is actually going to be an update on this decision to move back to Australia. What's everything I'm considering? And there is a lot, and it's different from the last time, because this time I'm changing tax residency. I will be an Australian tax resident. Last time that wasn't the case due to the tax treaty. Questions and answers. We're at the hour mark, right on the dot. I see Sean has another one. I realize much of this in regard to residential real estate. Yes, it is. However, would any of these considerations change in regard to agricultural farmland, or even, some of them would a little bit, but not dramatically. Not dramatically. So you can't, what's the first thing that comes to mind? You can't depreciate farmland. That's one thing. Commercial, you can. Most of the points, I mean, what are the main detriments? The lack of CGT treatment. That's massive right there. What sort of return would you need from an equivalent asset to make up for a doubling of the capital gains rate? Well, I would guess you need double the return. And that's maybe one of the thoughts to ponder from tonight's presentation is, I'm not saying Australian residential real estate is always bad. I'm intending on buying a house when we go back to Australia, because if one's planning on being there long term, I think that does make sense. But would I continue to own that property if I was moving back to the US? Very likely not, because of all of the reasons that I went through here. And I don't think it changes dramatically. The thoughts that will go through my head are opportunity cost of capital, and all the time and admin hassles that I'm going to have owning that property. I haven't seen any other questions come in here, so I wanted to thank you all so much for coming here tonight and joining me. Thank you, Pamela. And I just ask one small thing, and that is, if you found this valuable, then please don't keep me a secret. If you're out there talking to friends, or you're online or whatever, I do this, as you can see. This is not a hard sell at all. This is intended to be very valuable information that you can use. So thank you very much, and appreciate it, Robert. Look forward to speaking with you soon. Sean, you're welcome. And I hope to see you all next month. Have a wonderful night, folks.